Fantastic. Okay, welcome back everyone to our last session for level 2. And obviously after today, we will still have one more session next week for Q&A and a refresher. So rest assured, we will cover this all over again next week just to make sure everyone's on point. And also know, just like I mentioned on level 1, now that you have completed level 1 and level 2, every Sunday I can continue to provide support on anything that you need a quick recap on or anything that you need to confirm. Because what you would find with level 2, because level 2 is very flexible in terms of what you can do, it's not just for signals. You can identify rejections, you can identify milking areas, identify 2 types of signals. So because there's a mixture of stuff going on with the G boxes, what we tend to find is people continue to ask questions on Sunday as they get more experienced using the boxes, as they identify new patterns and new things that they need clarification on. And that's why I will continue to provide that support on Sunday. What I do need you to do is whenever you send me messages on Sunday to clarify or ask questions, please confirm that you are a level 2 member. Knowing that you're a level 2 member will allow me to answer those questions according to your experience. So always start with level 2 member and confirm the month. So you'd say April level 2 member. So that way, knowing what month you did the level 2 also allows me to know how much more detail I need to give you. So especially when I know it's April level 2, meaning that you're a recent level 2 member, then I know obviously I need to provide a bit more clarity in my answers because you don't have much experience. So rest assured, we will continue to provide that support for you guys, so don't worry. Okay. Now, just before we crack on with the session, I want to just quickly see if there's any questions, and I might not answer them straight away because knowing what questions you have, then as I do this lesson, I can incorporate the answers to it live while I'm doing it. So is there anything that is there on your mind right now that you want to ask? Okay, so we have one. I am a bit confused regarding some signals conditions. Bullish G boxes scenario. Let's imagine the candle is red and left a gap to the line above. My understanding that it is not valid signal as it does not cross above. In other words, does the last candle need to be blue? Bullish signal, that's correct. So Frank, for the bullish box, we need a bullish candle to close above to make it a valid, strong signal. However, if a red candle has also closed above that line and left a gap, it is still valid. It is still a valid signal. But as I always say, the bullish box is for buys. The blue candle gives you a stronger confirmation for the signal. Okay? Anything else that anyone's got on their mind that I can clarify before we start? Okay. So don't worry. As I do the session, some of the questions that you may have, you'll get more clarity around it. And it's one of those things that the more practice that we have, the more practice that we do, the more questions that are going to get clarified. Even now, you may not have no questions until you start practicing. So when you start drawing the boxes over the weekend and back testing, and then Monday, Tuesday, Wednesday, Thursday, you will have some questions. So don't worry, this is quite normal. So yesterday we did our bearish boxes here. And the day before we've got our bullish boxes here. And today I will show you how on a typical day you would switch between bullish and bearish. And just to clarify with you guys some of the notes that you've taken, I'm just going to quickly recap. So every day we need the previous day's G value. So this is the new day for trading. And in order to draw boxes, we need the previous day's G value to generate the box sizes. And to get the previous day's G value, we use the day's high, low, plus 300, divide by 2, and round up to the nearest odd number, allows us to generate this G value. And then this G value is used on this day to draw the boxes. And that is option 1, just drawing the current day's box and using it alone. Option 2 is when we move the box across and use the previous day's box on the current day independently. And then option 3 is if we then draw the current day's box on the same day, which has the previous day's box moved across, so it has 2 boxes overlapped. That is option 3, combined together, and that is the most true way of drawing G boxes, by having current and previous day's boxes combined together. So that's the main way to do it, okay? Now, when you draw boxes, you always use, for the bullish boxes, the lowest price, and then we stack up. Every time we get a new low in the day, we have to readjust to the new low and then continue to stack up. And we may have to do that for several hours, and then no more movement, as in no more new low, so no adjustment. And then we may get another new low, and then we adjust the box, and then if there's no further low, that box remains valid for the rest of the day. Same with the bearish boxes. We start from the top, and then we stack down. If there's a new high, like we see here, we would adjust the box to the new high and then stack down. And then from here, there's no further new high. So for the rest of all day, no adjustment needed. So basically, we only readjust the box when there's a new high on bearish boxes and when there's a new low on the bullish boxes. That allows us to get the most accurate levels for the day. And there's potential to be accurate every hour if there's a change every hour. And you'll notice the power of it as it happens. Bullish box, you only stack up, and bearish box, you only stack down. The only time you will do the opposite, i.e., the only time you will stack down a bullish box is when you move it across to the new day and there's a new low on that day and you can't draw the boxes for the current day. Then you will just stack down the bullish box. Same with the bearish box. You always stack down, but the only time you'll stack up is if in the following day price goes up and you don't have the current day's box drawn and you only have the previous day, which is lower, then you'll just stack the box up, okay? So those are the conditions of drawing the boxes. Then we have the conditions of signals. How do we identify signals? Signals on the G boxes are all about identifying gaps. And these gaps can be identified in 2 ways. One of them is via candle body close. So here, we have a body close below this line, leaving a gap to the next line, and that's a valid signal. Okay. The other way where we identify signals is through EMA 5 cross unlock gap. This is an example of EMA 5 cross between 2 candles. Candle on the right is the lock-in candle, and then the lock-in candle has left a gap to the next line. Enter on the next candle, goes and hits it. So, two types of activations, candle body close or EMA5 cross and lock, but both need to have valid gaps to be a valid signal. Okay. So these are the conditions of the signal activation, identifying and taking the signals. Okay. Now, I want you guys, before I continue showing how we use the boxes, I want you to get your pen and paper or notes ready, and I want to give you some new sets of conditions to add. And they are optional conditions that are not a must, but people can utilize them when the market changes in terms of volatility and size of ranges. And I've always given these conditions over the last few years, but the I'd say before Trump came on board, obviously the last month it's been nice and volatile with big ranges. But before that, the market was a bit more steady in terms of range size. So when I gave these conditions that I'm about to give you, because I've always given these optional conditions because I always expect the market to do big moves at some points of the year. But obviously traders don't know this, I know this. So when I gave these conditions, they're like, what's the point? The market doesn't move like that, we don't need it. And only now, they're messaging me saying, oh, Mr. Gold, those conditions that you gave us back then is quite useful now because I can see the market's moving in big ranges. And I'm like, aha, you see what I mean? So I'm going to give you those conditions now. So the condition 1. So write down condition 1. If G value is larger than 2,500, so I repeat, if G value is larger than 2,500, you can add optional quarter lines. So I repeat, if G value is larger than 2,500, you can add optional quarter lines. So I repeat again, if G value is larger than 2,500, we can add optional, so it's optional, it's not a must, quarter lines. Okay? And what I mean by that is, you see here you have the half line. Quarter lines are going to be lines between the half and the full. Between the half and the full. You just add, the safest way to get the value is add the half line value, which is here, add that to the full line value, the low, and then divide by 2, and that will give you the quarter line value. And you'll do the same for this one as well. Add the half line to the top line, divide by 2, will give you the quarter line. Okay. Now, basically, why we do this, and it's only optional, is when you have a big G value above 2,500, even here you can see 2,2 is quite big gap, but they're still tradable. But when it goes 2,500 and more, the gaps may be so big that it delays your TP for more longer. So as a day trader, by having the option of adding quarter lines, it gives us a smaller gap, quicker TPs. And you will see the quarter lines are not just random lines, they also get respected. Like the half line and the full line, they also get respected. Okay, so it's not a must, but it's optional. And over the last few weeks, you would see there's big G values. So by adding the quarter lines, it really gives my traders and myself those easier early exits. And not just exits, it gives more activations, because if you've got a quarter line, the quarter line can also be used for body close and EMA5 cross and lock. So once again, it's not a must, but it is an optional optional choice to add the portal lines. Okay. Now, another condition. If G value is lower than 600, you can remove the half line. Okay. So if G value is lower than 600, you can remove the half line. Once again, it's not a must, but it's optional. And what we mean by that is, if on this day we use this G value to draw the boxes, but the G value was 600 and low, then these boxes are going to be so tiny with the half line. By removing the half line, we get a more tradable box. And there's a similar example that I can show you here. Bear with me. On this day here, it's not 600, but it's 700. But can you see, we just about managed to get a few signals body closed. If that was now 600 and below, like 580, 550, these would be so small boxes. So by removing the half line, it gives us more tradable gap. So once again, it's only optional, but it does make a difference in getting the additional signals and exits and TPs. Okay? So those are the two conditions that I need you to write down. And then I have a final condition, which were not valid here since the last 4 or 5 days, because we've not had the situation here, but it can happen every so often. And those conditions, the last condition is, we call that, I'll give you the title, free box exhaustion rule. Signals and EMA5 cross unlock signals and candle body close signals are strong and valid up to 3 boxes. After 3 boxes, they get exhausted, they become weaker. So generally we don't chase any signals on the 4th box. And that's why we call it the free box exhaustion rule, meaning momentum gets exhausted by the 3rd box, and the 4th box, the signals become weaker. So we don't take them. Okay? So can you see, guys, this is one of the reasons why I said don't trade the boxes yet, because I need to give you the conditions. And these are very important conditions. So this was the last condition, the free box exhaustion rule. And I'll repeat, what we mean by that is up to 3 boxes, signals are still strong. When signals go into the 4th box, just use it for analysis and direction, not for trading, because they become weaker. Okay? Any questions with regards to these conditions? Or is everyone okay for me to move on? Okay, Frank, on condition 3, yes, sir. Yeah, obviously has to be the same direction. Bullish boxes, 3 boxes up. Bearish boxes, 3 boxes down. Did that answer that for you? Whether or not we took signals in previous boxes. That's nothing to do with the boxes. Whether you took the signal or not, that's your business. The point I'm trying to explain to you is up to 3 boxes, the signals are strong, not based around how many signals you taken. That's your business. I'm talking about strength of signals. Up to 3 boxes, they are strong. 4th box, they become weaker. Do we keep the boxes over weeks? I mean, we add and not delete. Your choice. You can delete the boxes after you finish with them, or you can keep them. That's totally your choice. As a professional trader, it's nice to keep them because then you can go back and look at historical data and do some back testing and check results and help look at and review situations that you could have dealt with differently. So it's nice to keep the boxes, but it's not a necessity. Any other questions? Okay for me to move on? Okay. So now let's go back to our typical bullish day. So now, this is how we would trade a typical day with bullish and bearish boxes. So on this day here, let's move this box away, keep the measurement the same, and just move it across. So on this day here, I would have started with a bullish box on the first low and a half line. That's all we would have had. And then on the bearish side, I would have had this done. Bear with me. And let's go for check the bullish again, just to make sure I've got that correctly. Okay. So this is how, on the first candle, I would have drawn my bullish box, and I would have done the same with my bearish box on the first candle. And like I said to you guys before, regardless of if I'm buying or selling, regardless if the market is going up and down, I don't know that. I don't know which way the market's going. So I draw both the bearish and the bullish box. That's what we do. Immediately when the market opens, I can see there's a gap left to the bullish line here. And immediately when the market opens, I can also see a gap left on the bottom one. So now, on the first candle, I can see a gap below and I can see a gap above. So as a trader, I need to decide what kind of trader I am. Do I trade both trades? I don't take both trades because I don't hedge my account. That's one of the biggest problem in this country, in this world of traders, is hedging. The market knows human nature. They want to take everything and they get burnt. So I don't hedge, but regardless, depending on what trader you are, you notice there's a buy and you notice there's a sell. So you may now decide that I'm going to take both, or you may decide I'm going to take a buy, and after I've taken my buy, I'm going to take a sell. Or you may decide I'm going to take a sell straight away, and after I take the sell, I'm going to decide if the buy is there. So the choice is yours. Or if you're Mr. Gold, you're only buying, so you look at this gap, and I'm going to tell myself, okay, I'm going to take a buy, but because I can see there's a sell gap as well. So it may reverse. It didn't reverse. It actually went and hit TP, but I don't know it's going to hit TP. It may reverse because I can see a gap there. So I may decide I'm going to go in a bit smaller for this target because there's a gap on the bearish box that may get hit. So it's just preparation, okay? And if I take the bullish target, it goes and gets hit. And if I took the bearish target, it also went and got hit, okay? So now, new candle low, I would adjust my bullish box in the next hour. So let's adjust. Now, after adjusting, for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, for the next 12 hours, no need to make no more changes here. So that's great. And now, on the bearish chart, on the second candle, I don't need to make any changes because there's no new high. So the bearish boxes still stay the same until here. But for the next 2 hours, bearish boxes stay here and bullish box is only adjusted. So let's see what goes on. So straight away, no further signals or nothing else going on here. So that's fine. 2 hours later, I'll also check here. Anything going on the bearish? No, nothing going on. Still the same gap still open. And then I get a new high. So I adjust my bearish box. So I'm just showing you what typical day looks like for a trader with bearish and bullish boxes, G boxes. This is how we trade. This is how we get the most up-to-date signals as well. So I've updated for the next 3 hours, no updates needed. I've updated my bearish. Bullish box again, no updates needed because I've already done my update and no new lows. So I continue normal for a few hours, nothing happening, that's fine. Switch back to my bearish, I get a new high. So I adjust that. So let's adjust. Adjust it here. Oops. I've moved my half line, bear with me. Okay. Nothing going on. Another new high, update again. And after that, no updates needed for the rest of today. I'll stack down another box just in case I need it. And I'll get my half line. And our bearish box needs no more updates. Switch to my bullish box. See what's going on. And I get a gap. Candle body close above the line. Gap to the next line. I enter. Oops. I enter on the opening. It reverses, reverses, reverses. 150 pip SL just here. Bang on here. I'll take my calibrated bounce for 50 pips. Doesn't give it. Reverses by 60 pips. And then goes back up and gives my 50 pips. So the SL gave me my 50 pips. Now, this is the beauty of these G boxes. If I didn't want to wait for the reversal and it started reversing, how do I know it's going to hit SL? What if it only reversed a little bit and then it went back up? I don't know. On the standard signals on the VIP channel, we don't give the G boxes, so nobody knows what's really going on. Oops, somebody sent a message. If we have active signal, we have to move the box. Our TP does not change, right? No, save this question for later, Alan. Let me just, I don't want to lose the flow. Let me continue with the flow of the lesson and then, because it's really, really important that I don't forget where my trail of thoughts. Where was I? Yeah, please, absolutely. I'm going to give you opportunity to ask questions. Do not disturb because I'm going to lose the flow of the lesson. Where was I? Yes, so we don't know if it's going to reverse and hit SL. We might think it's going to hit TP. So as a trader, this is the beauty of having the bullish and bearish boxes. Because when I saw this red candle and I entered straight away for this bullish target, and then I see another red candle, I'm like, hold on a sec. I've got a bullish signal activated. I've taken the signal, but I'm seeing red candles. Let me see on the bearish box if they're activating anything. Switch to my bearish box, and I'm like, okay, there's two red candles, nothing happening yet. So there's a line close by. If I get a rejection here, then I'm okay. If I don't get a rejection here and I get a signal going down, then it's going to potentially go further down. So I only reverse about 50 pips. So I've not hit SL yet, and I'm still holding the trade to see what's going on. And then I switch back to my bearish chart, and I notice, hold on a sec, now I have a candle body close and EMA 5 lock opening this gap here. That's a strong signal, EMA 5 and candle body close. So now I may decide to get out early and re-enter the trade from this section here because it's hit an SL, or I don't do anything. I tell myself, I'm busy, I've set my stop loss, and I've set my calibrated bounce for the 50 pip TP, and I'm done. Finished. Now, remember when I said that some people may not want to wait for the 150 pip SL and then the calibrated 50 pip bounce. Some people are front of the charts. And if you're front of the charts, you're watching it live, which means you've got time to milk that reversal. This is where the bearish box comes in. When a bullish signal reverses, the bearish levels become calibrated. When bullish signals reverse, bearish levels become calibrated. So you see here, you had to wait. Here's the entry. $150 pip here, and then you waited all day. Following day gave you your 50 pip recovery. But if you now wanted, you could have used this bearish level to milk trades in and out. Look how many bounces it gave. 1 bounce, 2 bounce, 3 bounce, 4 bounce. Let's see how big these bounces are. $50 pip, $50 pip, $50 pip. And then here, 20 pip, 20 pip, 20 pip. Generally, we like to, when we're milking, we don't go for 50 pips. We go for 20 pip, 20 pip, 20 pip, in and out. 20 to 30 pips. 50 pip is what we use for our full recovery, like what I've shown you here. With entering on the signal, reverse, 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 150 pip here, and then you take your calibrated bounce, and then you're done. But by using the bearish boxes, you are now able to milk this level. Now, before I give you more example, get your pen and paper, because I'm going to give you the theory behind why they become bounce areas. So it will help you understand why they become bounce areas. So this is a bullish box. Can you see? Bullish G box. Bullish G boxes are resistance levels. All of them. They're not support. They're all resistance. And that's why we get buy signals. Because when resistance breaks, price goes up. Okay? So write down on your notes. Bullish G boxes are all resistance levels. So I repeat, bullish G boxes are all resistance levels. So they're all resistance. Okay. Bearish boxes are not resistance levels. They're all support levels. Bearish boxes are all support levels. And I repeat, bearish boxes are all support levels. And that is why we get sell signals on bearish boxes, because if they are support levels, we are looking for a break of support for a continuation down. And that's why bearish boxes are support levels. When they break, we get sells. And bullish boxes are resistance levels. When they break, we get buys. Okay? So now, this is why I use the bearish support levels for milking buys. You see, bearish boxes are for sell signals. The only time you will use them for buys is when you're milking the support level when a bullish signal reverses. So you understand what I'm trying to say? Bullish boxes are for buys, bearish boxes are for sells. But when a bullish signal reverses, now you can use the bearish boxes for bounces because they are support levels. And because they're support levels, you can use them to milk buys for a buy signal that is reversing. And same with bearish signals. When a bearish signal reverses, so here, look at the opposite. Here we have a body close below this support line, confirming a continuation here. But it reverses. When it reverses, I now go to bullish box, which are resistance levels. And now I can use the resistance levels for bounces. So here was our sell signal going down, but it went up. Now I need to milk sells because it's reversing. I go to my bullish box and I can now use these levels to milk sells. So if I now enter here, look, 20 to 30 pips given, 20 to 30 pips given, goes back up this level, 20 to 30 pips given, 20 to 30 pips given, 20 to 30 pips given. Obviously, I'm not going to go all the way down here because it's already done 150 pips and recovery. But while it's within the 150 pips, let's see. Here's the signal activate. 150 pips is here. So the SO is here. So we get this whole day. So if we get the whole day, means you can milk this one, and that one, and then the SL gets hit. So you've already managed to get two, forget even these, just even here and here, you already managed to get two milking even before the SL calibrated bounce. The SL calibrated bounce would have given you the full recovery, and these milking ones would have given you extra profit. And this is the beauty about these boxes, where all this time I showed you bullish boxes are for buy signals and bearish boxes are for sell signals. But when the sell signal reverses, then you can use the bullish boxes for sell milking. And when a bullish buy signal is reversing, you can use the bearish boxes for buy signals to take buys from the levels. Make sense, everyone? I'm going to quickly answer Alan's signal. Alan was asking if we have an active signal and we have to move the box, does the TP change? So basically what Alan is asking, and I'm going to create a fake example to make it easy for you guys to understand. So Alan is saying, here we have a body close above this line, and there's the signal gap. But if we get a new low and the box changes down like this gap disappears now. Is it a valid signal still? Or it may become bigger, the box, as in when we adjust it, the gap may become bigger. Does the TP change? No, your TP will still be valid. It just means it may get delayed or it may get done earlier, but it still remains valid. Sometimes when signals get adjusted, as in the gap becomes smaller because the box gets adjusted, we tend to also adjust our TP just to get an earlier exit. But that's only to get an earlier exit, not because it's invalid. It's still valid. It just may get delayed. Sumit, you keep leaving and coming back. I think you have a bad connection. Try and get to a better location. Okay. So, once again, just to repeat the theory behind it. Bullish boxes are resistance levels. When resistance break, we look for buys. Bearish boxes are support levels. When support levels break, we look for sells. When bullish boxes break resistance levels and we take a buy and it reverses, we then jump onto the bearish support levels to milk buys. That's the only time you will use bearish boxes for buys, because otherwise they're for sells. Same for the opposite. When bearish support levels break and we take a sell, if the sell reverses, we switch to the bullish boxes with the resistance levels and use those resistance levels to catch sell bounces. That's the only time we use the bullish boxes for sells, because we use the resistance levels for bounce areas. Okay. Now, how many bounces will you take on the same line? Up to you, personal choice. People can take up to 3. I generally take 1 and 2. Up to 2 I take, but people can take 3. Now hold the question, guys. I'm going to give you a chance to ask questions. I don't want to lose the flow. Every time I'll give you the chance. Now, there's a very important thing that I wanted to share here right now. As I said, bullish boxes, when they reverse, that's the time you milk the signal on the bearish box. And same with the opposite. Bearish box, when it reverses, that's the time when the signal reverses on a bearish sell, that's the time you use the bullish boxes for sells. Now, there's something very interesting. Imagine there is no signal on the bullish box. And imagine there is no signal in the bearish box. Some people can still milk without a signal reversing. Normally, the signal has to reverse on a bullish box for the bearish box levels to become calibrated, and vice versa. The signals on the bearish box sells need to reverse for the bullish resistance levels to become calibrated. So a signal needs to reverse on the opposite box for the calibration. However, there is a way to take scalping signals of 20 pips without any signal activation. And we do that with what we call wick rejections. And I'll show you an example here. So here, bullish box for buy signals, right? Only for buy signals. Let me make an adjustment to the new low. Now, any areas where a wick has rejected the line and no body close on the bullish boxes will give 20 pip scalps. So anywhere you see wick rejections, so wick rejection, 20 pip scalp. This is a body close, so no wick rejection. Wick rejection, 20 pip scalp for sell. Remember, bullish boxes, but we're using the resistance levels to take a reverse trade. Rejections. Look, wick rejection, 20 pip scalp, wick rejection, 20 pip scalp, wick rejection, 20 pip scalp. wick rejection, 20 pip scalp, 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 wick rejection, 20 pip scalp. No further, no further, no further. Wick rejection, 20 pip scalp. This is a body close, so no wick rejection. Body close, no wick rejection. Wick rejection, 20 pip scalp. Body close, no wick rejection. Body close, no wick rejection. Wick rejection, 20 pip scalp. No body close, no wick rejection. Wick rejection, 20 pip scalp. That's on the bullish box. Let's go to the bearish box for the buys. Normally bearish boxes are for sells, but if we're doing reverse trading on rejections, we're going to take buys. So body close, so no wick rejection. Wick rejection, 20 pip scalp. 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 Body close, no scalp. Body close, no scalp. Body close, no scalp. Wick rejection, 20 pip 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 scalp. Body close, no scalp. Wick rejection, 20 pip scalp. Body close, no scalp. Wick rejection, 20 pip scalp. Body close, no scalp. Wick rejection, 20 pip scalp. Body close, no gap. Wick rejection, 20 pip scalp. Wick rejection, 20 pip scalp. Wick rejection, 20 pip scalp. Absolutely bloody phenomenal. So even when there is no signal, and you shouldn't do this too much, because remember, I told you this in level 1. Don't carry on until the market stops you. A couple of milking scalps is okay, but if you start taking every candle that moves, you're never going to know when to stop, and the greed will eventually burn you. But I just wanted to show you the power of these boxes. Not only can you trade the break of resistance on bullish boxes for buys, not only can you trade the break of support on the bearish boxes for sells, you can use the bullish boxes for taking reversal trade just with wick rejection, and same on the bearish box. You can also use the bearish boxes when a bull signal reverses for calibrated bounces, and you can also use the bullish box resistance levels for calibrated bounce sells when a bearish signal reverses. And then if you don't have any signal reversing, then you can just use those support and resistance levels with wick rejection bounces for milking 20 pip scalps. Absolutely beautiful. Makes sense, everyone? In the 1 hour candle, how do we know if there will be a wick rejection or no? You have to wait for the hour to close, sir. So here, let's have a look. Where is this? Is this bearish box? And here is bullish box. You would wait. Look, this is a wick rejection. You'll only find out after the hour's closed. You can't do it while the candle's moving, because that can close above the level and open a signal. You have to wait for the candle to finish, and now we can see it's a rejection, and then you would have taken a reverse trade on the opposite candle for 20 pips. That's correct. On the wick rejection scalping signal, do you enter on the next candle? Yep, I've just explained that. Okay. So if we now gave you the example here, rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Let's check this bearish boxes for the buys. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, 20 pips given. Rejection, enter on the next candle, and this one doesn't give the 20 pip. Here's the rejection, doesn't give the 20 pips, reverses down, we get a rejection here, gives you the 20 pips. Rejection here gives you the 20 pip. Rejection here gives you the 20 pip. Rejection here gives you the 20 pip. Okay. Make sense? No. This is a scalping signal. This is not our proper signal. Our proper signal on the EMA5 cross and lock, they give the calibrated bounce on 150 pips. These rejection, they're scalping signal. They do not give you a calibrated bounce at 150 pips. The SL is your flexibility, your choice how you want to do it. You may use a smaller SL of 40 pips. You may use a 50 pip SL. It's totally up to you, because like you've seen, it can give you 5 signals within the space of 3 hours. So if you take a smaller SL, it's no big deal, because within 5 signals, within the few hours, you're making it back. So the SL is flexible based on your appetite. Okay. So now, let me move on, bear with me, to option 3, both bullish and bearish boxes together. And they stay here. And let's do it from here. So that way no changes needed. And let's check the bullish boxes. Bullish box, we'd make an adjustment. Let's do it from here, because this is at the end of the day and we don't want to wait until the end of the day. We want to see some action before that. So let's move that up. Yeah. And let's move this up here. And let's move this box up. And half line. Okay. So on this day here, straight away opens a gap to here, goes and hits it. I also switch to my bearish box. That gap is the same gap from before, which we can see also goes and hits it. Switch back to my bullish box. Price goes up, up, up. We have a body close above this line, leaving a gap to the next line, and it reverses. Although it reverses, it goes and hits the TP, you can see. But let's see how much it reverses when I enter. Enter. Reverse, reverse. Okay, no SL. We still get our TP. So it reverses for 90 pips, and then it goes and hits TP. Now, this is the interesting part. As it was reversing, I saw red candles. The minute I saw the red candles, I switched to my bearish box to see what the hell's going on. I see on my bearish box with the red candles, there's no signals here. However, I see now there's a body close below this line, leaving a gap to this next line. Okay, so I can see it's going to go here. My buy signal is still open because no SL, so I'm still holding the trade. So no SL, so I don't need to add a calibrated bounce because it's still within the SL, and you can see it hits TP. But now I can take an extra trade, because when I saw on my bearish box wick rejection, look at that, wick rejection, I can now take a buy, extra one here, and take the 20 pips and keep it on trail and trail it to the original TP, which already has a signal open for. So I could take this one from here and capture a beautiful 150 pip ride, or I can just take a 20 pip here as an extra trade, and my original signal is still open, giving me 67 pips. So I can easily make over 200 pips or 180 pips with a 20 pip scalp from the bearish wick rejection. So you see why I said to you guys that doesn't matter if you're only buying, doesn't matter if you're only selling, doesn't matter if the market is going up, doesn't matter if the market is going down. You should always draw both bullish and bearish boxes because they can be used to do reverse trading. The bearish chart can be used for buys. Just like you use the bearish chart for sell signals, you can use it for reverse trading on wick rejections and to add extra trades when your bullish trade is reversing. And vice versa. The bullish boxes, those resistance levels, you can use for adding sells using wick rejections or adding sells when your bearish signal on the bearish chart is reversing and you need levels of resistance to know where to bounce off. So the multiple use of these boxes make them one of the most strongest tools that traders can use. And very rarely anyone is going to share a formula like this to you. And this is one of the reasons why I had to sign your and get your NDA signed. So far in the last 5 years, I've taken 3 people to court and I've sued successfully 2 people because they broke the terms of my non-disclosure. And I have absolutely no problem in aligning if I have to 100, 200,000 on a court case to take somebody down, because this is knowledge that nobody shares and I chose to share it to my community. And if you disrespect it, then rest assured I will align my resources to take that person down. And the worst thing is they lose out, because if you respect my knowledge, I will give you more. And if you think this is amazing, Eagle Eye and Hawk Eye level 3 is absolutely on another level. And that's why it's not for everyone. You have to prove to me with your performance and loyalty before I even put you on the waiting list. Okay. Nevertheless, this alone, the G boxes, is an absolute fantastic tool. You've seen it in action now. It's just beautiful, absolutely beautiful. And the flexibility of switching from, this is why at the start, at the beginning, when you guys kept saying, oh, do I have to draw the bearish boxes? Do I have to draw the bullish boxes? And I said to you, it doesn't matter. Look, I only buy. Mr. Gold only takes buys. But why do I draw bearish boxes? Because I only buy, I love the bearish boxes. Because I only buy, I have to use the bearish boxes more. Why? One of the biggest strategy that I use on every statement is I buy dips, buy dips, buy dips. How can you buy dips? You need support levels. And where is my support levels? It's on the bearish boxes. So I'm a buyer who only buys. I'm a bullish box guy, but I use the bearish boxes more because I'm taking bounces from dips. I love these support levels. If you actually look at these support levels, every single one of these support levels have given pips. Check this out. This is not a signal, but I wanted to check this out. Bearish box, right? Mr. Gold only buys, and I'm going to use this support levels. Check this out. Support level here. Look, movement. Support level here, 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 movement. Absolutely brilliant. Check this out. Support level here, movement. Support level here, movement. Support level here, movement. Support level here, movement. Every single one of these support levels are giving us bounces. So as a bullish trader, only taking buys, I seem to be using the bearish boxes more. So this is why I said to you guys, and I continue to say this to you guys, don't be lazy, whether it's going up or down, whether you're buying and selling, it's always wise to draw both the bullish and the bearish boxes together. And there's a reason why we call the G boxes, the nickname for G boxes is navigation system for XAUSD. These bullish and bearish boxes are true navigation system for XAUSD. Absolutely fantastic. It's a proper navigation system, absolutely proper navigation system. The only thing I will tell you to be mindful about is you see the G value formula that can change once every 3 years, potentially. Right now, you are okay for the next 2.5 years, 2 years. It is absolutely paramount that you stay on the channel and be with us in VIP if you continue to stay as a long-term trader and make this a big part of your life. Because if you make this a big part of your life, then you will need an update that's needed. I mean, if you only do it for a couple of years and then you disappear, then no issue. But if you become a full-time trader and you have plans to do this for 5 to 10 years, then in 5 to 10 years, this G value signal may need to be tweaked 3 times. And I will give those updates free of charge. There'll be no charge. I won't be that person who will tell you, oh, by the way, guys, your G value boxes have now become weaker. If you want an updated G value formula, you need to pay me money. I'm not going to do that. That's my commitment to you guys. Every time I tweak the G value formula, I will give that to anybody who still maintains my student and still with me. If you're still with me, you will get that update without no issue, no problem at all. Okay? You have my assurance. Any questions? I'll take the questions now. I know I've done a good job explaining it, so you may not have any questions, but nevertheless, if you're typing, no problem. And also, you will need some time to practice before the questions come up. So I understand that. I understand that you may need some time to practice. Do you take the intraday level? So no, intraday level is something completely different. It's not something that I'm teaching. These are completely different. Can you share the G value formula again? Yep, I can. You should have written this down on the first day, so please make sure you write it down. High minus low equals plus 300 equals divide by 2 equals, and then round up to the nearest whole odd number. Also, the wick should touch the next line. What's this for? Sorry, Michael. What are you talking about?
Sorry, is it for the signal? Not the signal. Do we have to touch the wick? Has to touch the next line to take the buy or the sell?
For what? Sorry, what are you talking about? What signal are you talking about?
No, not the signal. We're talking about the scalping.
Scalping, nothing to do with wick touching the next line. It's just a fixed 20 pips.
Yeah, but the previous wick has to touch the line or not?
It has to reject, so it has to touch the line. Otherwise, there's no rejection.
Okay. Thank you.
What? Because if it's not touching the line, then there's no rejection. It has to touch it or close below it, then it confirms the rejection. These are all rejections. If it's done this, let me zoom in. If it's, imagine here, this is a body close, And here, this wick has not touched or closed below it, so there's no rejection. So that's not a signal for scalping. Here, that's a rejection. So we reverse trade the 20 pips. Okay. Do we still need the intraday levels after we have? Yeah, of course, intraday levels are my daily levels that I share. Gold terms are my weekly levels that we share. G boxes are levels by the hour. They're all different. It's like a builder building a house and he's saying, I've got a drill now. Do I need a screwdriver? Absolutely. You may have a drill, but you'll still need a screwdriver for certain delicate jobs. The screwdriver, the drill may punch through and damage the wall or the furniture. You need a screwdriver to hand tie it in. So just like a builder will have multiple tools to do the same job in more than one way, same with our trading. Just because you have G boxes does not mean you ignore your gold turns or the intraday. All of these tools are now part of your toolbox. Make sense, Chingni? Any other questions? Everyone clear? Okay, so now I want to finish up with sharing prop firms, tips and tricks on prop firms. So now, for those of you who don't know what prop firms are firms, companies that give you challenges that if you pass the challenge, you get an account that you can trade with. These accounts are demo accounts, but you get paid like a live account. So for example, you will buy a 100K account. So you can buy a 100K account or, for example, $500. You then have a target that if you do 8% profit, they will pass your phase one, and then some of them straight away give you the 100K account, or some of them then give you phase two, where you have to then do 4% profit. Soon as you've shown that you're making profit on those accounts and pass that challenge, they then give you that account to trade on a profit split. Meaning every 2 weeks or every month, whatever profit you make, you can withdraw 80% of it. So traders like myself, I have my own accounts that I trade, and I also have prop firm accounts with FTMO and Alpha Capital of 200K, 100K accounts where I trade every month and they pay me money. Okay, that's one. One of the rules these prop firm accounts have are consistency rules, meaning you can't keep changing your lot sizes and not add more than 2, 3, 4 trades of layering. So when you trade my system with a prop firm, you have to tweak the style a bit. Your personal account, no problem, you can trade exactly how you've learned. But when you're trading prop firm account, when you take the 150 pip stop loss, you can't now make the entry on the calibrated recovery 3 times the original entry, because then you will break the consistency rule. Because prop firm accounts, you have to keep the lot sizes same or similar. So you can't take a 50p trade, hit a sell and take a £1.50 trade. So the way we manage trades on prop firm's account is when it takes an SL of 150 pips, we don't put 3 times the lot size, we put the same lot size in, which means we can't recover the full trade in one bounce. We just recover some of it. And that's absolutely fine, because we don't need to recover the full trade by 3 times the lot size and then break the rule. So instead what we do, we continue to use the same lot size, but we use the boxes and we milk in between, and we take wick rejections like I've taught you to cover that signal reversal. So that's why I wanted to share this with you, that with prop firms, because of the consistency rules, you can use the milking to manage those positions rather than going 3 times the lot size. Okay, so that's an important tip. Number 2, there is also something called HFT prop firms. HFT prop firms are prop firms that you can get past, and I've got somebody that passes a lot of our traders' accounts for them. With a fee of a couple of $100, they pass the challenge for you with a robot. And now, straight away, you have a live account. You don't have to do any challenges. However, there's a problem with these HFT prop firms. And the problem is we find them, and everyone knows they're not very reliable. After a few payouts, they stop paying you. So the best way to utilize them is have the correct expectation. And what I mean by that is I love those dodgy HFT prop firms because I don't expect them to pay me forever. I get it passed for $200, buy the account for $300, $500 total spend, I get a 100K account. And as long as I get a couple of payout, $2,000-$3,000, I've made money, I'm up. On the third payout, if they reject it and close it, I don't mind. I'm not upset. I'm like, okay, I've made minus my $500, I've made $3,000, I'm up, let me buy another one. So I buy another challenge with another HFT. And I do it again, spend $500, take a couple of payouts, $2,000-$3,000, and then if they reject me, no problem. I lose $500. I made $2,500. I move on to a next one. And then there are HFT prop firms that don't close it. They let me continue to get paid out, and I've been getting paid out for 9-10 months from them, like Optimal. Optimal has continuously paid out. The worst thing they do is they delay the payment sometimes. Sometimes I'm waiting 4 to 5 weeks, but they eventually pay, so I'm still happy. Now, because my expectation is correct, where I don't bank and rely on them, I'm happy with them. But somebody else who has the wrong expectation, they want to pay out every day, every month, and don't expect them to not pay out. If the prop firm then doesn't pay them out, they're really, really upset. They're really upset and they hate HFT prop firms. They're scammers, they don't like them, and that's it. Because they have the wrong expectation. Because I have the right expectation, I don't mind the HFT. So what I tend to do, I have a mixture. And this is how my mixture works. I have my own accounts, so I have 2 to 3 own accounts, 100K, 200K, 50K, whatever it is, I've got a couple of my own accounts. I then have 2 prop firms that are my main prop firm accounts, FTMO and Alpha Capital. Those 2 are not HFT, they're proper prop firms and they're reliable, they pay out. So I have my own liquidity, my own accounts. I also have 2 prop firms, non-HFT, Alpha and FTMO, as my reliable prop firms that regularly pay me out. And then I have my run rate in and out, shake it about, mess about prop firms from the HFT. Wherever I get from them is bonus, added extra cream on top. Night out, I don't care if they don't pay me. Wherever I get, I'm happy. And that's my combination of accounts. My own accounts, legitimate prop firms, and HFT. What do I do with my HFT money? And what do I do with my prop firm money? Everything that I make, I spend some, and rest of it I load up to my main personal accounts. Because ultimately, as traders, the only person that you can ever rely on is your own money. And that's why whatever I make from prop firms and etc., I cannot bank on them for life. So I keep a lot of the profits and I load up my personal accounts. That way, I'm not reliant on prop firms. Whatever happens in the world with prop firms, I will still have my own liquidity in my own trading account that I can confidently earn with small risk money every month. Okay? Any questions? that's just with experience. You know, the people who struggle managing loads of accounts are people who rush. They're, oh shit, I need to quickly open this account, I need to quickly open this account, and they're trying to open all accounts. I'm very relaxed. I'll open one account, I put a trade in. I'll open another account, I'll put another trade in. By the time I've opened my third account, if it's already gone into good profit, then I'm not going to enter on those accounts. I'll leave it. If I see by the time I've opened my third account is reversing, then fantastic, I'm getting a better entry. More than likely, by the time I've opened 7-8 accounts, I've managed to get a way better entry on those accounts that I can actually get out in profit earlier. So the key is relax, be patient. Nothing's running away. So I have no issues trading multiple accounts. I'm in no rush. Any other questions? All okay? Everyone okay? Give me a yes. Good. So now, get some practice in. You've got a good few days to practice. You've got a weekend to practice. You've got next week to practice. And stay on the level 2 channel so I can keep you updated. And on the Thursday next week, we will do another recap and Q&A. Okay? Well done, everyone. Thanks for being patient, listening to me blab on once again. Please, please, please respect the risk management. As you can see, market is moving aggressively. Be smart. Don't let the market fool you. Okay? Well done, everyone. Thank you so much. And I'll see you all next week. Take care. Bye, everyone.